Hello, my host. Can you hear me?
Yes, we can hear you and see your screen.
Oh, thank you very much. Oh, good evening, everybody. Welcome to today's class. So we pick up from where we stopped. Okay, so basically we have talked about introduction to financial accounting. At the center also we have talked about the elements. We have talked about the rules of double entry. So this time around, we want to talk about, before we move into preparation of financial statements, we need to talk about the adjustments that have been done. I remember that you have done journal, you have done ledger, you have done how to post into journal, and you know how to post into ledger at the moment. So now, well, let's take further by preparing financial statements. But before we prepare our financial statement, there is always an adjustment that we made, that we normally made on the trial balance before we can prepare our financial statement. Remember, when we talked about the first class that we had, we talked about the accounting process. And under the accounting process, we talk about that other accounting process. We talk number one is collection and analysis of data. Number two is posting into journal that we have done. Number three is posting into ledger that we have done. Number four is what? Preparation of trial balance. Number five is adjustment of trial balance. So we need to what? We need to prepare adjusted trial balance. I think that there's a figure in your trial balance that needs to be adjusted before you can now move to the next step, which is preparation of the financial statement. So at this level, you expect to know like 4 to 5 adjustments to your to your trial balance before you cannot prepare your financial statement. Adjustment of figure simply means there are some transactions that you have not recognized or that you have not treated in your financial statement or on your ledger that need to be addressed. That need to be addressed. So that's what they are referring to there as what? As the adjustment of final account. So for this purpose, we'll be talking about 4 of them. Number one, we talk about depreciation. Number two, we'll talk about bad debts. Number three, we'll talk about accrual and prepayments. Number four, we're going to talk about earn and unearned income. These are the adjustments. This is your level that you expect to know. My colleagues also have taken IS2, which is inventory. Okay. Now, after that being said, let's move into the what we understand by non-current asset, what we call depreciation. Depreciation is actually a reflection of non-current asset, and that will take us to a particular standard that we call IAS 16. That's property, plant, and equipment. IAS 16 is actually the standard that address anything that have to do with tangible asset. That's what we have to do with property, plant, and equipment. And remember, maybe I've said so, that whenever a financial transaction occurs, before you record it in your financial statement, you have to ask yourself which standard address or which standard explain how this transaction should be treated in my financial statement. It means that the standard is the go between your financial transaction and your financial statement. Now, IAS 16, if you talk about IAS 16, you need to talk about some things. Number one, you need to talk about measurements. You need to talk about measurements. Now, measurement means that how do we value the transaction on our financial statement? How do we recognize it? Well, at what point do we recognize it? If we recognize it, at what value do we use to introduce such transaction in our financial statement? Basically, we have three types. We have three types of measurements. We have number one, we have the initial measurement. Number two, we have the subsequent measurement. Number three, we have the recognition measurement. These are the three types of measurement that we have. And this can be likely to human being as well. For example, when a woman, when they give back to a human being, that is what we call initial. So that person just start existing on the earth, on the surface of the earth. So that's what that is. So it's still a what? A baby. So that is the initial measurement. The introduction of that baby into the real world is initial measurement. Now, and after that, the baby will go through some phases. From after that, they go from teenagers down to your adulthood, age, and everything. So all those phases that is changing over time is what we call subsequent measurement. Subsequent measurement. It means that it's changing phases over a particular period of time. That's what we call subsequent measurement. You know, when it's a child and when it's a teenager, the treatment and every other thing will be different, right? It means that maybe it's taking milk before, but now it's no longer taking meat. It's no longer taking milk. It's not taking meat, stuff like that. The collecting allowance before, now it's an adult. It will collect allowance again. If you want to give allowance. So these are the example of what the subsequent measurement, the phases of that person goes through. Then, if the person now grow old and now die, that person is no longer on the world. That means that person is no longer living. That is no longer living on the earth. So it means that we need to remove that such person from the record. That we call derecognition. Derecognition. It means that if you do population census right now, that person will not be counted because it's no longer what? It's no longer a living person. So it means that that person is taken off the earth. So once they take it off the earth, it means that we are derecognizing him or her as a living being on the earth. So we are separating him from the earth. So that's actually what the recognition. So if you understand that, you understand this standard very, very well. Okay. Now let's talk about initial measurement. So initial measurement talks about when you just purchase your asset. When you just purchase your asset, what are the things that you do? So what you need to do is you need to know the total amount. You need to know the cost, or how are you going to recognize it? If you purchase asset 1 million, are you going to introduce it to your financial statement as 1 million, or you are going to introduce it at 900,000? So it depends. Now that's the question that initial measurement tries to address. That is the question that initial measurement tries to address. Now it says whenever you purchase an asset, and that item that you purchase fulfill the recognition criteria, which means that it is measurable. Number two is that what? That it's actually what is in line with the definition of the element. If it's in line with the definition of the elements and is measurable, then you can go ahead and what? And recognize it in your financial statement. You can go ahead and recognize it as financial statement. And so far that what you are part of those that they are carry out the transaction. Once you are part of those that carry out the transaction and you can measure it, at the same time also it fulfills the obligation or the definition of the element of financial statement, then you can go ahead and record that transaction in your financial statement. So if I purchase an asset now, based on my definition, that said an asset is a resources control as a what? As a result of what past event, which is a what? There will be inflow of future benefit into the entity. So that's what it is that if I put in any resources right now, and I'm going to benefit from the result over a particular years, I can regard that to what an asset. So it means that if I'm going to enjoy that asset for that 1 year, 2 year, 3 year, 4 years, that is what we call non-current asset. So how do we record that transaction in our financial statement? The way we record that transaction in financial statement is we pick the purchase price or the market price or the listed price. They can call it listed price, purchase price, or market price. So we pick the or quoted price. So we pick the price. They will now less trade discount. If there is trade discount, we reduce it to what we do, reduce that purchase price with our trade discount and now add every other relevant cost to it, to the point of where the asset will be available or ready for use. It means that purchase, so the formula is purchase cost minus trade discount plus other relevant costs or direct costs. Costs that is directly attributable to the asset, purchase of the asset. So you add everything together until the asset is now ready for use, or the asset is ready for use. So it means that, for example, now, if I purchase a motor vehicle, I purchase it from outside the country, the cost of the motor vehicle is there. The cost of shipping it from outside the country down to my country will be added to it. The cost of clearing it will be added to it. The cost of if I need to work on it before it can be ready for you, every other thing will be added onto it until the vehicle will be readily available for use. So all costs will be added together, and that will now be used to introduce your vehicle to your what? To your financial statement. Now, if you look at this example that we have here, the example says that a company purchased a large item of plant. A poor company purchased a large item of plant, so they gave us the list of the plant. They now ask us, what is the cost of the plant? They ask us the question now, what is the cost of the plant? So if you want to get the cost of the plant, you need to now ask yourself several questions. Number one, list price of machine. List price of machine is the actual quoted price. So you have 1 million. Trade discount given to company. Remember, I said purchase price less trade discount. We give you what? We give you so you have to what? You give it the actual amount you paid. So you have the purchase price minus discount. So always remove discount. Then delivery cost. Is delivery cost actually relevant? It's relevant because if we decide not to buy the plant, we are not going to incur the cost. But if we buy the plant, we are going to incur the cost. So it means that the cost is directly linked to the purchase of the plant. So delivery cost will be added to the cost of what? Cost of purchase. Installation cost also will be added because if we don't buy plants, we are not going to install anything. So that will also be added to the cost of the plant. Cost of site preparation. Cost of site preparation also will be added because the reason why we incur this cost is to prepare the ground for the plant to be installed. So if there's no ground preparation for it, there's no way to install our plant. Architectural fee as well is actually direct cost as well because it's the one that works on the site, looking at the corners, the placement, and everything. So it's actually a direct cost. Then we have the administrative expenses. Administrative expenses is not a direct cost. If we decide not to buy the plant, we are still going to incur the administrative expenses, either by paying salaries, rent, stationaries, water, and the rest. So it means that administrative expenses is not a direct cost. That will not form part of our assets. Now, if you go to the next page, let's look at the next page. Let's see the solution next page. Can you see the solution of that one? But we now have, so if we had everything together, just based on my explanation, we now have 1,390,000. This 1,390,000, this is the value of your motto of your plant. That is the value of your plant. It means if you are recording it in your financial statement, you will not record it as 950,000, which is the machine cost. No, you will not record it as 950,000, which is machine cost. You are going to record it as what? 1,390,000. That what we call cost model. And the accounting treatment is that you are going to debit plant account because plant account is an asset account. And whenever asset increases, you do what? You debit your asset account. Now, then you credit. Which account are you to credit? The account that you're going to credit depends on the type of transaction you have carried out. If it's cash transaction, it means that there is what? There is a movement of cash that will affect your bank account. But if it's credit transaction, you have received the plant, but you have not paid for it, then that kind of payment will be under the what? Other payable account. It will be a liability because you have received the plant, but you have not paid for it. And when you look at liability is defined as a present obligation as a past what? As a result of a past event in which the settlement will lead to outflow of economic resources or what? Of economic resources from the entity that embezzles the resources. It means that this amount now that we have received the plant, but we have not paid for it. So that is a present obligation. That is liability. So it's been credited to other payable liability, other payable liability with the total amount of the plant, which is 1,390,000. Now, that is initial measurement. That is what we know as initial measurement. So IS 16 now says that there are two methods that we can use to value our assets. Two methods. We have what we call cost model, and we have revaluation model. These are the two models that we use. These are cost model or revaluation model. But for initial measurement, we use cost model. For your initial measurement, we use cost model, and this is what cost model is all about. Evaluation model is comparing what the fair value compared to what? To your carrying amount. So that's what the evaluation. I look at, okay, if I want to dispose of this asset now, how much will I able to get it? The fair value less, okay. You get that compared with your carrying amount. But at this level, you're not expected what you're not expected to go deep into revaluation, okay? You're not expected to know about revaluation deep. Just have the idea that we have two models to what? To use to value our asset, cost model and revaluation model, cost model and revaluation model. Now let's talk about improvements. Okay, the next one I want to now talk about is, there are two types of expenses. There are two types of expenses on the asset. There are two. We have what we call capital expenditure and we have what we call revenue expenditure. And both of them are what? Are on assets. Okay, let's continue with the plants that we have. The plants. So we have what we call capital expenditure and revenue expenditure. What is capital expenditure? Capital expenditure simply means the amount that you have decided to spread across a particular year. And these are the amount as a result of improvements. Is the cost that you incur on the asset that improve the productivity of the asset or increase its estimated useful life. Okay, that is actually what? That is capitalized expenditure. It means that it will increase the cost of the asset. It means if your value of your asset at the book for at the current is 90,000, and you now incur a capitalization, or you now incur a cost of 50,000, and you want to capitalize it. So what you do is just add 90,000 plus the 50,000 of the amount that you want to capitalize. Now, what are the results of capitalization? Well, let's use the common example. I use motor vehicle a lot because I believe that we are all used to that. Plant, if you have not worked in a manufacturing company before, you might not understand plants. So let's use motor vehicle. Now, let's say, example, I purchase the motor vehicle worth 1.5 million naira. 1.5 million naira. And I decide to change the engine. If I change the engine will cost me 700,000 naira. And once I change the engine, if the vehicle have 2 years span before, immediately I change the vehicle, it's going to increase to what, 4 years span. And improvement also what will increase. If the vehicle normally has start and all these things, the improvement will increase. But looking at the amounts also that are spent compared to the actual cost of the vehicle, is actually what is like 50 to 60% of the actual cost of the vehicle. So it makes more sense for me to spread that amount that incurred over a particular period of time, because I believe that value, if I can't just recognize that total expense in the year that I pay for it, because I'm still going to enjoy some benefits from that expenses that I've incurred. So that is the logic about capitalization. We're talking about this money that you have spent will bring in benefit to you in later years. 1 year, 2 years, 3 years, you will still be enjoying that benefit. So don't charge everything. Don't charge everything on for the year alone, but spread it across the estimated useful life of the asset. That's capitalization. Now, the revenue expenses. These are actually expenses that are used for maintenance purpose. So they are the expenditure on a non-current asset after the acquisition. So after the acquisition, now it's treated as what? After acquisition, now is used to maintain, repair, maintenance and repair of the motor vehicle will now be revenue expenditure. How? If I need to change my tire, number one. Number two, I need to change my filters. Number three, I need to buy oil. I need to put petrol. And all these things are what? They are just maintenance. Change the oil, gear oil, engine oil. All these things are maintenance. Is the year before 2 months or 3 months or 4 months, you still do the same thing. So you can easily expense that. That's what we call revenue expenditure. Now, revenue expenditure is found under statement of profit or loss account. It's found under statement of profit or loss account. Why capital expenditure is found under the statement of performance position. So the statement of financial position is found under the statement of financial position. So the amount that you capitalize is found under statement of financial position. So that is actually the difference there. They can ask you to differentiate these two. So you need to know how to differentiate them, where to find them, and areas to link them to. Now, moving forward further, there's what we call depreciation. Now, this depreciation is actually relating to subsequent measurements. Now we have bought this asset, we have recognized it, the initial measurement. This asset, we have used it. First year we use it, second year we use it, third year we have used it, fourth year we are still using it. It is not right for us to still retain the same value in year 1 to year 4, because that value of the asset will have dropped as a result of our usage. So if the value of assets will have dropped, it's very compulsory for us as an accountant to also show the effects of the usage on our financial statement. Because if we refuse to show the effect of the usage on our financial statement, it means that we are not giving the true picture of the company state, company position. So it's very, very important for us also to what? To reflect the usage of the asset on our financial statement. And that is the backbone for what we call depreciation. So according to the IS 16, depreciation can be defined as the systematic allocation of the depreciable amount of an item of property, plant, and equipment over its estimated useful life. This is what it's saying, that don't just be objective about spreading the cost of an asset, but you do it in a systematic way. It means use employ some techniques, employ some formulas that will help you to spread this cost along. Remember, they said that what is actually what allocation of depreciable amount of the item. So the depreciable amount is the cost of the item. So if we purchase a multiple for 1.5 million, that amount is what we call the depreciable amount. And they say that what is expected to over its estimated useful life. So if we purchase an asset cost 1.5 million, and we have now decided that this asset will go to last us for 10 years, 10 years, it means what is the value of the asset that you're going to enjoy on a yearly basis. So to get that, you just do 1.5 million divided by 10, and that will give us 150,000 naira. Am I right? Yes, I'm right. So that's what we're going to give you. Okay? So now, giving you that figure, it means that on a yearly basis, the value of the asset that you enjoy, the benefit that you enjoy, the wear and tear on the asset, or based on passage of time, is 150,000 on a yearly basis. Remember, it's calculated on a yearly basis. So it means if at the end of the year, if at the beginning I have 1.5 of the motor vehicle, at the end of the year, I'm going to remove 150,000 away from it to give me the total amount of the asset that I have not yet utilized. Then that 150,000 naira, I will not take it to the profit or loss account according to Marshall concept, which talk about relating the expenses to his revenue. Okay, let's move on. So let's talk about the terminology before we move. So we have what we call depreciable assets. Depreciable asset is an asset that has the following features. Number one is have useful life more than a year. Number two is acquired primarily for production purpose. It's not acquired to be for resale purpose. It's acquired for production, to generate resources, to be used for production, not to be used during production, not to be consumed during production, but to be used for production. Okay, has a limited useful life. Don't have a limited useful life. If it does not have a limited useful life, it cannot be depreciated. For example, land. Land is assumed not to have what a limited useful life, like it exists for a long period of time. So that is one of the reasons we don't depreciate land. So we believe land appreciates over time. Not intended for sales in the ordinary course of business. So any asset that falls under these features can be regarded as depreciable assets. They will now have residual value. What is residual value? Residual value is an estimated amount recoverable from the disposal of the non-current asset after its expected useful economy life. If the asset is going to use for 5 years, and at the end of 5 years, we say we can still dispose this asset. If we let go of this asset, we are going to get 50,000 naira back in return. That 50,000 naira is what we call residual value. The asset, the cost of disposing the asset at the end of this estimated useful life, the cost that you recover, the money that you recover from it, amount recoverable is what we call residual value. And it's also called scrap value. It's also called scrap value. Then in terms of that, it's also called salvage value. It's also called salvage value. Okay. Now, obsolescence. Obsolescence actually talking about the factor that render a non-current asset useless, even though it is in good physical and working condition. Obsolescence simply means that when the asset, obsolescence simply means that when the asset, everything, obsolescence simply that when the asset is actually in good condition but cannot be used. It cannot be used due to its passage of time. Example, maybe there's change in technology. When there's change in technology, the must be what you are using right now is what is old. It's actually invoked, it's not invoked again. So it's within that word that obviously is out of fashion. So you need, even there's nothing wrong with it, it's still working fine, but because it's out of fashion, you need to get another asset. Okay. Now, the depreciation that we have talked about, there are several ways for us to calculate our depreciation. Several ways for us to calculate our depreciation. We have straight line method, we have reducing balance method, we have revaluation method, we have some of the year digit method. We have several of them as well. Okay, so let's pick some. Now, this, remember in our definition of what? The definition of asset, we said is what? Is a systematic allocation of what? Of depreciable amount, administrative asset. Right? Now, this is the systematic allocation. Remember, I said systematic allocation simply means in using of techniques by removing subjective attributes away from the allocation. So what we do is we introduce a systematic way, and that is using formula, using techniques, using method. So one of them is straight line method. So straight line method is actually talking about when you get the cost less your scrap value divided by its useful life. To get the value of the asset that you want, the value of the value that you benefit from the asset on a yearly basis. So the formula for calculating straight line method is cost divided by cost minus scrap value divided by estimated useful life. So, and based on this, because of the name straight line method, the depreciation will be on what? Will be the same throughout the year, except if the asset was purchased, during the year. So any asset purchased during the year and the company does not state that their policy is to recognize full depreciation at what? At the full depreciation at the year of purchase, then you cannot go ahead and do that. Okay, so that is one of the things that you can do that. That was one of the words you can do that. So now let's move on. The next one we have is example. Let's talk about the example. A machine costs 100,000 naira. The machine costs 100,000 naira, and after that, sorry, excuse. Okay, a machine costs 100,000. It has an estimated useful life of 5 years. The salvage value at the end of the 50th year is estimated to be 100,000. What is the annual depreciation? Now you take 100,000 minus 100,000, which is the cost, minus salvage value, which is also known as scrap value or residual value. So minus it means that the total worth of the asset that you want to consume for a particular period of time is 90,000 naira. 90,000. Now, how many years do you want to spread it? You want to spread it through 5 years. So now be 90,000 divided by 5. So it means on a yearly basis, the value of the wear and tear on the asset will be 18,000. It will be 18,000. So we just get this now. We are going to talk about the account entry. Okay. So we have not get to the account entry yet, but get this working first. Please, this topic is 100% sure that they will set it. IS 16 is 100% sure that it will be tested in your exam. 100%. and it will have nothing less than 20 marks. It will have nothing less than 20 marks. Okay, please do pay attention. Now, residual balance method. Residual balance method is actually the one that is used to, as what they use the percentage, is used to tell percentage to.
Reducing balance method.
Yeah,
Yes,
reducing balance method.
Okay. Okay, so reducing balance method. Under this method, a percentage is charged on the written down value of the asset annually until it is disposed of. It is only at the end of the first year that the charge will be on the original price. So now, how do you calculate that? You look at it, says that, please read it accordingly and work with it. It says, under this method, a percentage is charged on the written down value of the asset annually until it is disposed of. It is only at the end of the first year that the charge will be on the original price. Now, this is what, how do we get our written down value? Written down value is the opening cost of the asset minus the initial depreciation. I'll come back, I'll say that again. Written down value is the opening carrying amount of the asset. So excuse me, there are two ways you can do that. Two ways to get our tax written down value is doing the opening carrying amount minus depreciation for the year. The opening carrying amount minus your depreciation for the year. Or you do cost minus accumulated depreciation. Cost minus accumulated depreciation. Those are the two ways in which you can calculate our written down value. Written down value, okay? So we do cost minus accumulated depreciation. Accumulated depreciation means that the addition of all depreciation recognized throughout the assets or throughout the what asset on for that particular point. It means, for example, what I'm saying is, if we have an asset for 3 years, your depreciation for year 1 plus year 2 plus year 3, the three of them will be what? Your accumulated depreciation. So you now remove it away from your cost. Now let's look at example 2 to explain that. Example 2 says a machine cost 100,000 is to be depreciated at 20%. What will be the depreciation expense at the end of 3rd year using reducing balance method? Now, they ask us to calculate for the 3rd year. So you get the first cost of it is 100,000. So after this first year, so there's no depreciation. This is the first time we want to calculate depreciation on it. So we do 20% on 100,000. That gives us 20,000. So it means that our depreciation cost for the first year is 20,000. That 20,000 will be recognized under our profit or loss account. For 2nd year, we do 20% of the balance that remain. The balance that remain. In 1st year, we have 100,000, but we have used what? 20,000 out of it. So 100,000 minus 20,000 will give us what? 80,000. So that 80,000 is the new carrying amount. So you now do 20% of the 80,000. That gives us what? 16,000. After that, we now go to the 3rd year. The 3rd year is 20% on the carrying amount for the year as well. So now look at ourselves. What is the opening carrying amount? As at year 2, the carrying amount is what? Is 80,000. So we have opening, okay, carrying amount is 80,000. Then what was the depreciation for year 2? The depreciation for year 2 was what? 16,000. So 80,000, which is my carrying amount now, minus 16,000, 20% of it, they give us 12,500. They give us 12,500. So that is that about the what we call reducing balance method. Now let's move on to evaluation method. Now evaluation method is actually the value. So what we do is look at, okay, what is my opening balance beginning of the year, the value of my asset at the beginning of the year, plus my addition of assets minus the worth of my asset at the end of the year. So the differential state of it, the difference of it, we give what we call depreciation for the year. I'll give us depreciation for the year. So let's look at example 3, for example. We have other has a van worth 20,000 at the beginning of the year. So at the beginning of the year, his van was 20,000. During the year, during the cost of the year, he purchased additional van costing 10,000. So it means that if he have 10,000 at the beginning of the year and 10,000 worth of van at the added to it, it means that it's expected to have what 30,000 worth of van at the end of the year. But you now say that other value the total worth of van at the end of the world at the end of the year to be 25,000. It means that I don't now look like, oh, what is my fair value? If I actually want to dispose of this van, how much can I realize from the disposal of this van? And then that's okay, our disposal is 25,000. So it means it will be very wrong for me to still carry it at 30,000 because at the end of the year, it is no longer 30,000. So I need to reduce it. And the differential or the different figure is what we know as the depreciation for the year. So give us 30,000 minus 25,000, and that will give us the depreciation for the year. Okay. Now, after that being said, we now move on to what we call accounting treatment of depreciation in the ledger. So we have done method of calculating depreciation. Now let's talk about how do we treat depreciation. How do we treat depreciation? So remember, we are what? We are under the subsequent measurement. Subsequent measurement. So we want to look at the first year, we have recognized it. So what happened is for that year, what happened to the second year, what happened to the third year. So that's what we're going to look at now. Now there are two methods that you can use to record to treat your depreciation. There are two ways of treating your depreciation. Now, the first way is that the asset account will be credited with the expense and the depreciation account debited. Now, the first way is that your asset account will change. It means your asset account will change over the years. That was the first method. So your depreciation will be used to reduce your asset directly on the asset account. Directly on the asset account. So now it's also to use example 1. The example 1 is one that gave us the 100,000. The 100,000 minus I think 10,000 divided by divided by 5 years. That will give us that. So that's example 1. So that's our example 1. So the first thing is that we purchase the assets. Okay. So if we purchase the assets, then it means that you do what? If it's let's assume now it's a pay cash. A pay cash, okay? So it means your cash is given, you credit your cash account, your machine account, which is your asset account, is receiving, so you debit your account, it's increasing. So what you do is what you debit that account that with 100,000, the actual cost of the asset. Then after that, we now look at what's the depreciation for the year. Your depreciation for the year is 18,000. It means that you want to reduce the 100,000 by what? By 18,000. So for the first method, that 80,000 will be credited. 80,000 will be credited to your machine account. Then it will now be debited to your depreciation account. That your depreciation account is found under the statement of profit or loss account as an expense. It's treated as an expense under the statement of profit or loss account. So that's the way we have the balance. So you credit your asset account, then debit your depreciation account. Depreciation account. Then at the end of the year, your depreciation account does not normally have balance carried down. No, depreciation account do have balance carried down. The same thing goes to the income, revenue, or expense account. But their balance is written off to profit or loss account. Their balance is always written off to what? Profit or loss account, because their expense account, they are just for the year. Revenue account are just for the year. So they are always written off to profit or loss account. That is why if you look at the machine account now, so we have posted 100,000 on the debit side, we have posted 18,000 on the credit side. So we need to balance it. The difference between the 100,000 and 18,000 will give us 82,000. Now 82,000 plus 18,000 on the credit side will give us 100,000. On the debit side will give us 100,000. It means that our balance, the value that we have left to use for the machine is 82,000. Now for the depreciation angle, what we do is we have debited it already, because double leg, there must be a minimum of 2 entry must be posted for a single transaction, or your entry must be even. It can be 2, 4, 6, but they have to do what? The even. That's a transaction that require you to post more than twice. Okay, so we have the machine to be on the debit side. Now we need to balance it. So how do we balance it? The credit side will now be written off to profit or loss account. It's written off to profit or loss account. Please don't write balance carried down. The only time you write balance carried down is if you have not closed for the year. So you have balance carried down. But once it's for the year, it's always written off to profit or loss account. Now, the second method is that your asset account will stay. You'll be intact. Not we have your asset account. Your asset account will remain the same irrespective of the depreciation year in, year out. It will remain the same. So it will be as cost model. That's cost model. So that's actually one that goes with cost concept. It goes with the cost concept. So that's where then instead of you now crediting your depreciation to the asset account, you will now credit it to a new account called accumulated depreciation. Accumulated depreciation. That's the new account you are going to open for the method. So for the second method now. So for the second method, you'll be having 3 accounts. You'll be having the asset account, accumulated depreciation account, and you'll be having depreciation account. Now, asset accounts, we post when we purchase the asset, we post it on the debit side, it remains there, except we want to dispose it, or there's a revaluation. Now, the accumulated depreciation and the depreciation account, we owe the figure. So if you now look at the 18,000, the 18,000 for the depreciation for the year, first year, what do you do to it is you now go ahead and credit your accumulated depreciation. You credit your accumulated depreciation, then debit your depreciation account. You debit your depreciation account. Then after that, your accumulated depreciation will have balance carried down. If you want to close the account, your accumulated depreciation will have balance carried down because it's treated as an asset account. But on what? It seems like what, like a liability, like okay, this is not an expense, but it's a what? It's a liability, but it's charged against. It's charged against the asset. It's used to reduce the asset. Okay. So that's the way we treat accumulated depreciation account. So we have balance carried down for it. So it's not written off to profit or loss account. Please, accumulated depreciation is not written off to profit or loss account. It's always having a balance carried down. But depreciation is always written off to profit or loss account. So I believe that is fair. Okay. Now, okay, even there is a note there. Note, the depreciation account is to be closed to profit and loss, that's profit or loss account, as part of the business running expenses, which are deducted from the gross profit and other gains. We're going to get to that when it comes to IS1. That will be our what we're going to do next class. We are going to talk about IAS1 and also we talk about other topics. So that's what we talk about here before arriving at the net profit for the year. Why accumulated depreciation account will appear in the statement of financial position. So we now have an extract. This way is going to look at for the method 2. For the method 2, that we now have no current asset, we bring down the balance brought down, the balance carried down of the machine. The balance carried down of the machine, we put it down there, 100,000. Then after that, we now less the accumulated depreciation, which is 18,000. That gives us 82,000. That gives us 82,000. So that is how we record. That's how we record the transaction of that. Okay. Now, another thing now is okay. Another thing we need to talk about now is what we call the recognition measurements. Now we want to talk about the recognition measurements. Now we have talked about initial, we have talked about subsequent. Now we want to talk about what? Now we want to take this, we are no longer party to the asset again. We want to let the asset go. We are no longer what? Interested in the asset. It means that we need to remove the asset from our record. That will call disposal of non-current assets. Disposal is related to the recognize of assets in our financial statement. And whenever you dispose of an asset, you must ask yourself this question: are you making gain or you are making loss? Are you making gain or you are making loss? Very, very valid question to ask yourself. Very valid question to ask yourself. So the question that says that, how do you calculate your gain? How do you calculate your loss? How do you know if you are making gain or you are making loss? So the way to know is we calculate. No, the general way of calculating profit is what? A selling price, or let's say sales minus cost. That's the way. Sales minus cost. That's the way of getting our profit. So if we sold something for 20,000 and our cost is 15,000, so our profit will be what? 5,000. So for this purpose, our sales is what we call sales proceed. Our sales figure is what we call sales proceed less disposal cost. The sales proceed, which means the amount that we receive from the asset disposed minus the cost that we incur before we dispose of the asset. It might be commission, it might be transportation, it might be funding. These are the costs that, okay, before we were able to sell this asset, we actually incur this cost. So this cost is directly related to the sales of the asset. That's what we call what? Disposal cost. So if I want to get my sales will now be what? My sales value minus disposal cost. That will give me the net sales that I have received. I will now go to the other side, which is cost. How will I get my cost? Remember, when we purchase the asset, we introduce the asset into our financial statement by what? By using cost model. It means that there's no profit element on the figure that we carried our asset. It means that the carrying amount of the asset at the point of disposal is the cost of the asset. So we just took a look at sales minus cost equals to profit equals to loss. And that formula is what is broken down to give us this template or this format. So we have sales proceed on disposal, we have the figure, we have less disposal cost. That will give us net disposal value or net sales proceed. That will give us. Then the next thing that we're looking for is we are now looking for cost. So for presentation purpose, cost is now under another naira sign. Just for clarity purpose. Remember, one of the enhancing qualitative characteristic is understandability. And one way you can achieve your understandability is presentation, clear presentation of your workings. That is why cost is what on the other naira side to actually differentiate it from our sales proceed. So how do we get our carrying amount? We get our carrying amount by saying cost minus accumulated depreciation. Cost minus accumulated depreciation, or we do opening carrying amount minus depreciation for the year. It means that at the beginning of the year, what is the carrying amount? If you are using, we have two methods. You can carry it at cost. You can carry your asset either at cost or as carrying amount, or what we could know as net book value. So it means at the beginning of the year, what is my what? What is my carrying amount? Then maybe I now dispose that at the end of the year. So there is a difference between the beginning of the year and the end of the year. So I'll not say what is my depreciation for the year. I'll calculate my depreciation for the year. I will now remove it from my carrying amount to get what for my opening carrying amount, so that I can get my closing carrying value or amount. I will explain that again. Please listen. For me to get my carrying amount or carrying value, the first formula is cost minus accumulated depreciation. Cost is the amount that you have used to introduce that asset into the business. And now do what? Minus accumulated depreciation. Now, accumulated depreciation is related to all the depreciation from the purchase of the asset to the point in that you want to dispose it. All the depreciation will all be added together to give you your accumulated depreciation. Now, if you minus cost minus accumulated depreciation, will give you your carrying amount. Method 2, if you don't have cost and they gave you opening balance or what they gave you carrying amount, the opening figure, which means at the beginning of the year, this is your carrying amount for this asset. What you need to do is you need to calculate depreciation for the year and use it to what? And use it to charge against the carrying amount given to you. So that will give us what? The opening carrying amount minus depreciation for the year. But if their policy says otherwise, that depreciation will not be charged at the year of dispose, then you are not going to calculate depreciation for that period. Okay? Now, once you do that, that will give you your carrying amount. Now, your carrying amount will now be used to reduce your net disposal value. So if your net disposal value is greater than your carrying amount, that is gain. But if your net disposal value is less than your carrying amount, that is loss. And gain is recognized on profit or loss account. The same thing as loss is recognized on the profit or loss account. Now, gain is under gross profit. Loss is under expenses. Now, let's use a question to explain that further. We now have that a non-current asset cost 96,000 and was purchased on 1st June year 1. Its expected useful life was 5 years, and its expected residual value was 16,000. The asset is depreciated by straight line method. The asset was sold on 1st September year 3 for 68,000. There were no disposal costs. It is the company policy to charge depreciation on a monthly basis. The financial year run from 1st January to 31st December. What was the gain or loss on disposal? They can give you this mark. They can attach 5 marks to it. They can attach 3 marks to it. It's good to go. Now, the first thing you need to know is what is the sales proceed? What is the value received or value placed on the asset? What is the value received or value placed on the asset? That's what we call sales proceed. Now, if you read it here, they said that the asset was sold. So we actually sold the asset on 1st September year 3 for 68,000. So that is our sales proceed. 68,000 is our sales proceed. Now, After they now told us that what there is no disposal cost. So there's no need for us to less any figure from our sales proceed. So now we have our sales proceed. The next thing we need now is our carrying amount. Now they gave us the cost of the assets, and they gave us the years of the assets, and they gave us the what the residual value of the asset. So far that they have given us the cost and they didn't give us carrying amount. So we're going to use cost minus accumulated depreciation to arrive at our carrying amount. The cost given to us in the question is 96,000. Now, how do we compute? Sorry, excuse me. So now question is, how do we compute our depreciation? The way we compute our depreciation is by calculating the number of years that we have used, number of months, because they say that the depreciation is on a monthly basis. So what are the number of months that we have used for it? So let's count from year one, 1st June year one. So we can't count that. That's to start from June, because it's 1st of June. So June is part of it. So June to December 1st year is how many months? 7 months. The second year is how many months? 12 months. 12 plus 7 will give us what? 7, 8, 9, 19 months on its own. Now in year 3, it was sold on 1st September. So it means that the month before September is where we are going to end our computation. So it will be from January to August. January to August. Now, what is the January? How many months do we have from January to August? That should give us 8 months. We have 8 months. Now, 8 months plus 19 months. That's for the first year is 7 months. Second year is 12 months. Third year is 8 months. The addition of these 3 months will give us 27 months. Now, how do we now calculate the depreciation per year? So on a monthly basis. So we now go at okay, looking about our formula, straight line method. Straight line method is saying that the cost of the asset, which is 36,000, minus the residual value, which is 16,000, divided by its estimated useful life, which is 5 years. If you do 19,000, then it's 96,000. So we can get your calculator. I'm getting mine. 96,000. So I have 96,000 minus 16,000. That'll give us 80,000. 80,000 divided by 5, that'll give us 16,000. Now, this 16,000 is the total expenditure for the what? For the whole year, for 1 year. But we need it in month on what monthly basis. That 6,000 is for 1 year. Divide it by 12, it will give you per month, and that will give us 1,333.333333. That is the cost of your depreciation per month. Now, for us to now get the total accumulated depreciation, we now look at what is the how many total months that we have used the asset, that we are in what, that we are in custody of the asset, and the asset is in custody of us. That we go to 27 months. So 27 months times the depreciation per month will now give us 36,000. That is what we call the accumulated depreciation. So 36,000 minus 36,000 will give us 60,000. So the carrying amount is 60,000. That's the cost, the worth of the asset in our record at the point of disposal, which is 60,000. Now 68,000 minus 60,000 will give us 8,000. Now the sales proceed is higher than the current amount, so that's a gain. So we make gain of 8,000. So this is the what we call as the computation on how to calculate gain or loss on assets disposed. Now, after that being said, now let's now worry. At this point, we need to know the accounting entry. So we are done with the mathematical aspect of it. So this time around now we are looking into the accounting treatment. So the first one is we need to remove the asset from our asset account. When we purchase it, what we did was that we debited the purchase of the asset into our what? Asset account. So we debited it. But now we are letting it go, we are disposing it. So we need to remove what we debited. So that's why we credit the non-current asset. So by crediting the non-current asset, you are removing the cost of the related asset disposed. Of that asset disposed, you are removing the cost of the asset disposed. So we now go ahead and debit disposal account. You go ahead and debit the disposal account. Then after that, you now move to your next step, which is the accumulated depreciation. You know, you are using cost concept. It means that your depreciation does not affect your asset account. Where that depreciation is being owed is under the accumulated depreciation. So what you need to do now is you need to remove the accumulated depreciation of the asset that relate to the asset disposed. Because if you dispose of a Benz and you have depreciated the Benz over the years, you need to remove the depreciation element of the Benz away from your fleet of cars. Okay, so that is what you do there. So you go there also, and in that way, what you do is, because if you want to increase, now if you want to increase your accumulated depreciation, you credit it, right? You credit it and debit your depreciation account. So for this time around, you want to reduce it. So what you do is you debit the accumulated depreciation account with the value related to it, and you now what? You now credit disposal account. You credit the disposal account with the accumulated depreciation for disposed asset. Now, after you are done with that, the next step is now to ask yourself question: what the sales proceeds I have received? How do I account for the sales proceeds? For me to account for the sales proceeds, what I need to do is my bank. Is it my bank receiving or is it paying? Did I sell on credit or actually sold? We were receiving cash. So if it's as a result of bank transaction, then it means that my bank will increase. So I'm going to debit my bank. And why am I debiting my bank? Is because I dispose of an asset. So I'll go to the disposal account and credit the account. What is this one stating there? Credit bank. Okay. Now let's look at it logically. So now I've received payments for my what? For my assets. Once I receive payment for my assets, my bank will increase. So I go ahead to debit my bank. Then my disposal account will increase. So I go ahead to credit my account. So that is a correct thing. So I credit my disposal account and debit my bank account. So that's entry kind of wrong. Okay, it's correct now. Can you see that? You can see it there. With the sales proceeds of the asset disposed is correct. With the sales proceeds of the asset disposed. That's that. Okay. Okay. Now let's pick the former one, the one that we just computed gain on. Now let us record it. So if I want to put it in accounting way, I don't want to put it in mathematical way or using in column way. So I want to put it in an accounting way. So first of all is I'll look at where is my cost coming from. My cost is coming from the asset account. So I credit my asset account and debit my disposal account. That's 96,000. Can you see that under the disposal account? Cost of an asset disposed, 96,000. Look at cost of asset account. I have disposal on the credit side, 96,000. So it have net off the figure that I have in my asset account. Now, I need to do the same thing also for the accumulated depreciation. The reason why you are seeing this one clearly is because it's only one account, it's only one asset that we have there. There are sometimes you can have like 20 assets So if I remove one asset out of 20 assets, you might not see the figure clearly like this. So please don't be when they give that exam, don't be afraid. Just follow the principle and you'll be good to go. Then after that, we now have the accumulated depreciation. So let's take it away. So we debit accumulated depreciation to reduce the balance in that account. So we go to disposal account and credit it with 36,000. Then the other leg now comes to bank. So our bank receives, so our bank will be debited. Then why is our bank being debited as a result of asset disposed? So we come back to what? We come back to the disposal of disposal account, and credit the account. So now, after you have done with that, you now balance it. The left hand, the credit side will give you 104, that's 104,000. But the right hand, the debit side will give you 96,000. There's a difference there. The difference there is as a result of gain. So if your balancing figure is found on the debit side, that is gain. But if your balancing figure is found on the credit side of disposal account, if it's what found on the credit side of the disposal account, that is loss. That is loss. That is loss. So that is how that is being calculated. That is how it's being calculated. So the last one, okay, I want to talk about here. The last one I want to talk about here is what we call disposal part exchange. Part exchange disposal of property, plant, and equipment. That part exchange of an asset, old asset. Now, this one talks about we are not actually letting go of the asset, but we are not letting go of the asset for cash, but we are letting go of the asset to get a new asset, to get another asset. That is the meaning of part exchange. So we are buying a new asset, so we are adding money to it to get a new asset. That's part exchange. So for example, you have a phone that you are using. Let's say you have iPhone 11 and you want to move to iPhone 12. So you tender your iPhone 11 and you now add money to it to get iPhone 12. That is what we call part exchange. That is part exchange of an old asset in a situation that allows the seller to determine the price of the present own and use non-current assets of the buyer in order to be considered in the transaction of the new non-current asset. So you are submitting your old current asset. We have this, so the seller will now determine it. What is the worth of this asset that you are bringing? Once you determine it, you now go ahead and place a value on it. So let's look at an example. Let's look at an example on that. Then we move on from there. Okay. Now let's look at example 5. A company has several motor cars that are accounted for as non-current assets. As at 1st January 2022, the cost of the cars were 120,000, and the accumulated depreciation was 64,000. During January, the company bought a new car costing 31,000 and was given a part exchange allowance against an old car of 8,000. The car being part exchange ordinary cost is 8,000, and its accumulated depreciation is 18,000. Required: calculate the gain or loss on disposal of an asset of the old car. B, show how the purchase of the new car and the disposal of the old car can be recorded in the ledger account. So in order for us to do that, we need also to calculate our gain or loss. Do we make gain or do we make loss? We need to calculate that. So A passage, calculate the gain or loss on the asset disposed. Now, if you look at this question very well, there's no sales proceed. There's no sales proceed, right? There's no sales. They didn't give us direct sales proceed, but they gave us the value that was placed on the old car. The value that was placed on the old car. The value that was placed on the old car will be our what? Will be our sales proceed. It means that that is the worth of the asset. The market worth of the asset that we are letting go is 18,000. Sorry, it's 8,000. 8,000. Sorry, 8,000. Then after that, we now go ahead to calculate our carrying amount. So they gave us the cost to be 28,000, and now they solve it for us by giving us accumulated depreciation to be 18,000. Now, 28,000 minus 18,000 will give us 10,000. If you look at it closely, our worth of the car is 8,000, while our carrying amount is 10,000. No, it's lower than what the carrying amount. That will be loss. It's lower. It means that we have actually we didn't realize the value of the asset that we have carried over in our book. We are unable to realize it in full. So that is that about that. Then the big partnership show how the purchase of the new car and the disposal of the old car can be recorded in the ledger account. Now, they are asking us to do this. In order for us to do that, what we need to do is we need to follow the initial steps that I explained earlier. Is actually the same. The difference there is that the way we are going to treat the worth of the car, the worth that was placed on the car by the seller, or the old car by the seller. That is the major difference there. That is the major difference there. So instead of it, so the bank is not involved here. Bank is involved in form of payment, but it's not involved in form of receiving. So bank this time around is giving us cash. It's not receiving any cash. Okay. Now let's move. So the first method, the first thing is to do is remove the worth of the asset that was disposed. And what is the worth? Please do not do mistake by saying 8,000. Oh, the cost that was purchased, the cost that we have it on the debit side is 8,000. So we need to remove it. So first thing first, deposit the credits, the motor vehicle account with 28,000. And the second leg will be found under the disposal account. Then after that, we move on to the accumulated depreciation. I see where I'm taking it. After that, so that you won't forget the exam. After that, you go to what? The accumulated depreciation. Remove it. That's 18,000. Which means that the associated accumulated depreciation of the asset disposed, remove it. Can you see that our opening balance is 64,000 under the accumulated depreciation, but we are taking out 18,000, not the 64,000. We are taking out 18,000 because that is the accumulated depreciation of the asset disposed. Now, after you have done that, the next thing now is we need to now compute for value that was placed on the old asset. We need to now do the value that was placed on the old asset. So we go to how do we do that? So we go to the disposal account. We credit it with what? The worth of the old car. We are going to credit it with the worth of the old car, which is 8,000. Then we now come to the asset account and debit it with the what? With the worth placed on the old car, which is 8,000. We will debit it. The reason why we are debiting it is because value actually comes from the old car back to the company. It means the 28,000 was not actually worth. That 20,000 is not the lump sum that left the company. But what of 8,000 of that asset was enjoyed back by the company? So you have to recognize it. Now, what is the new? If you look at the question, what is the total? The new car bought. The new car bought was what? The worth was for 31,000. Now the question is, how much did they pay for it? Remember, they did part exchange, which means they will not pay the full payment for what? They won't make the payments. They won't pay the full for the new assets. So what they will do is they will remove the worth of the old car away from the cost of the new car. The difference is what they will now pay. Now, if you look at 31,000, that is the actual worth of the new car. But we are letting go of an old car worth 8,000. So 31,000 minus 8,000 will give us 23,000. So the actual amount money paid is what? Is 23,000. 23,000. So what do we do on that? You now go to your bank account, you credit it because an outflow is reducing your asset, your bank. So you credit it with 23,000. They will now come to asset account and credit and debit it with what? With 23,000. With 23,000. If you look at it, this is what we have here. Can you see it there? That's what we have. Can you see? Okay, I think it's clear. Then after that, you can now close your account. You can now close your account. So that is what, once you close the account, you're going to get lost because your debit on your disposal account, your debit side is higher than your credit side. So it means your balancing figure will be on the credit side. And I said, anytime your balancing figure is on the credit side of disposal account, is regarded to a loss. And that loss will be found under the what? Statement of profit or loss account or loss account. Now, disclosure requirement. Now, ISS now asks also told us that once we have done with all what we want to do, there's a need for us to disclose what we have used, to disclose to give a more backup to the figure that we have recognized in our financial statement. So part of what we are expected to disclose is the measurement base. What measurement do we use? Do we use cost model or evaluation model? We need to state it. We need to state either we use cost model or evaluation method. Also, we need to state the type of depreciation method that we use. We need to state it. Another one also is that the useful life of the asset also must be clearly stated. The gross carrying amounts and the accumulated depreciation at the beginning of the year, the cost, the gross carrying amounts, the cost, and the accumulated depreciation at the beginning of the year must be shown. The way you reconcile it also must be. So reconciliation means that what? At the beginning of the year, you have the worth of asset of 1 million. At the end of the year, you have worth of asset of 5 million. What has happened? So it means that you want to agree the opening balance with the closing balance. So if there's disposal, you recognize it. If there's an addition, you recognize it. So that is what that is talking about. Okay. So that is that. Then we now have also asset classification is as edge for sales in accordance with IFRS 5. IFRS 5 is actually what is an asset, not correct asset edge for sales. It means this is not asset that you are going to use for your production again. It's an asset that has been clarified and set aside for sales due to from management. Management has to show commitment before you can decide what to recognize it under IFRS 5. You are not expected to know that, so please for now just let go of IFRS 5. There are also acquisition of new assets through business combination. We are not expected to know that also, but that is actually part of the disclosure that IAS 16 require. That if we actually have goodwill, what is the acquisition of assets that we have acquired from business combination? We need to add them together. Impairment loss as well. You don't need to do that as a reduction in economic value of an asset. You don't need to know that as well. So that is that about IAS 16. That's that about IAS 16. So that will be the end. You can ask your question now. I'm giving an assignment. This question 1, 2, and 3 is an assignment. So you can solve that. You can ask your question now if you have any. Question time. Please use the chat button to ask your question. Okay, no question, right? In absence of question, I think we still have some time. Let me check. I think we still have some time. Oh, okay, let's look at the other material. Let's look at the other material. Okay, so okay. Okay, so this is the second adjustment. This is the second adjustment that we talk about on the final accounts. That is what we call the bad debts and provision for bad debts and doubtful debts. So this is it. Now, if you look at this now, we have what we call so we have three types of debtors, and debtors as a result of rendering credit facility. So it means that when people patronize an organization and they don't pay cash, they don't pay cash, which means they don't pay now, but they pay later. That's the meaning. If you pay now, that's cash, but if you pay later, that's credit facility. So it's the company is exposing itself to a lot of risk by doing that. Okay, by doing that. So it means that you give rooms for debtors. Debtors are those that own you as a result of the transaction that occur between the two of you. Now, we have three types of debtor. We have good debtor, we have doubtful debtor, and we have bad debtors. The good debtors are those that are willing and able to pay. They are willing, they have the mind to pay, and they have the financial capacity to pay. So they don't like to disappoint, and they like to keep their integrity, and they like to keep the self-respect for themselves. So you have no what? You have no risk, and you have no risk on that. So they'll surely pay you once the earlier the once the due date, maybe before the debt matured or on the date of maturity of the transaction. So that's good debtor. They will not have the doubtful debtor. The doubtful debtor are those that what they are willing but not able to pay. They have the mind of paying, but there's no financial capacity to actually pay. That's the doubtful debtors. So they are doubtful debtors are very good customers. They are not very good customers. Good debtor are very good customers. Doubtful debtor are not very good customer because it's 50-50. You are not sure if this person is going to pay this money or not. So you're exposed to a lot of risk or certainty. Oh, this person might pay me, this person might not pay me. It depends on the situation that is on ground. Then we have the bad debtors. That is the worst of them all. The bad debtors are those that do not have the what? They don't have the ability to pay, and they are even unwilling to pay. Amy, I just remember something now. I remember a song now, sung by Fast. So let's continue. So you know what? You don't remember actually you don't have money and you're not even ready. So even the willingness is not even there. Even if when money now comes, you're not even ready to work. To even pay the money. So that's bad debt. It means that the company might not realize their money outside. Once the company cannot realize the fund outside, it's better to work to expense it, to expense it. So that's one of the way they treat it. That's bad debt. So now the accounting treatment for that baffled debt is actually a summary of that. So we have the accounting treatment for baffled debt. We have how do we recognize it? There are two ways. There are two ways to do that. So we have now we're talking about treatment of bad debt. I said also we'll be talking about provisions or allowance for bad and doubtful debts. So we're talking about that. So for treatment against the bad debts. Now there's no need for you to plan this. It's actually very straightforward. When you make sales on credit, when you make sales on credit, what you do is you credit your sales account and debit your trade receivables. It means that your trade receivables is holding that money pending your debtor pays you. That's the meaning of that trade receivable account. It means that this is the value that is outside, the money that is outside, that is yet to that we are expecting, yet to be received. That's the what the trade receivable is all about. Now, if you have made sales and you have debited your trade receivables, then that money that you're expecting now refuse to come in. That money that you're expecting, you now notice that, oh, maybe the debt of your debtor or bankruptcy of your debtor or inability of the debtor to actually pay. So you want to write it off. That's bad debt, permanent debt that you're not expecting to want to recover. So you want to write it off, it means that you need to take it away from where you are keeping it for. Where are we keeping it? We are keeping it under trade receivables by debiting trade receivables. But now we need to take it away because that money we are not going to get it. So we want to take it away and put it under the bad debt. So what we do is we credit trade receivables account with the bad debt. We credit it, then we now go ahead and pay second leg. Now, once we credit a leg, we have to debit the other leg. So we now go to the bad debt account. We go to the bad debt account and debit it. So bad debt account is actually what that expense account. It shows that it's real to time as an expense account. So we go to the and credit that account. Now, it's possible maybe the person that they declare bankrupt right now, bankrupt that the bankruptcy is on it, it can later 1 year or 2 years now get the fund back again. So when you get the fund back again, and it now pays the money that we have initially recognized as bad debt, we can now go ahead and create another account, now say call it bad debt recovery. Bad debt recovered. Now, bad debt recovered account is not a gain account. It means that, oh, the money that I said that is not coming in, now that came in. So once the person now pays you, your bank will receive it, so you debit your bank. They will now credit your bad debt recovered. So bad debt recovered is actually what is a gain. Is a gain. So that is actually the way to treat your bad debt. That's the way we treat your bad debt. Now the question mark there is on the provision for bad debt and doubtful debt. So that's one way, that's one of the places where students normally have challenges. So now when talking about allowance or provision for doubtful debt, now it means that you are not sure if this person will pay you your money when it is due. So it means that you are saying 50-50 chance probability of that person paying you. Okay. So if it's probability of a person paying you, it means that based on your experience, you are looking at my 100% will not be my 100%. I will not be able to take my 100%, but I might take 95%. So 5% of it should be my provision. Let me just make provision for it. The reason why you are doing provision is you are trying to show as much as possible the true financial position of the organization at every point in time. At every point in time, so that is true and fair at every point in time. So then you now look at it, oh, this amount I'm expecting 10,000 naira from 5 people, but the 5th person might not pay me my money, which is, let's say that one have like 1,000 naira inside that 20,000. So he might not pay me that 1,000. So I can decide to make that 1,000 my provision. So I will temporarily reduce the amount I'm expecting outside. So it's temporary reduction as a result of what actually happened. So if we eventually crystallize, let's say eventually it comes to pass that the person fails to pay me, it will not affect my organization because I've not overstated my financial position. I've already made provision for it. So it's just a shock absorber. So if it eventually happens, you still be good to go. But imagine you have been expecting 20 million and you didn't make any provision. And out of that 20 million, 10 million is not coming again, and you have paid plan for it. That's a huge, it will actually shake the business. It will affect a lot of liquidity. It will bring about a lot of liquidity issues. So that's the way we do it. So now the way we record the allowance or provision for bad debt is that the first year it occurs. You debit your profit or loss account and you credit your provisions account. Or some people normally put it under bad debt. So you just debit your bad debt with your provisions for allowance. Nobody will penalize you. Okay? Nobody will penalize you. If you put another bad debt account, you will not be penalized. But if you show it like as a line item on the face of your FS as well, you will not be penalized. So it depends on the way you want to do it. Okay. So you go ahead and when you go ahead, so you have that figure, you put it under the bad debts. So you debit it, then you go ahead and credit your provision for the first time. For the first time. Now, subsequent year now means that is the increase or decrease in the figure that you are going to recognize. Now, in my first year, let's say my provision is 200. What I will do is I will debit my profit or loss account, or I will debit my bad debt and credit my provision account. That's 200. Now, if at the end of second year, I now realize that my provision is as a result of your trade receivable. It's not a result of your opening balance. So my opening balance is 200, but my closing balance, after I calculate it, and I said my closing balance should be 500. So what am I going to record under my profit or loss account is the difference there, which means the increased element is what I'm going to record as an expense. So whenever there's an increase in provision for doubtful debt, is what is added under the expense column. Okay, not the 500, not the 200, but the difference. So that's the accounting entry for that. The accounting entry for that is I credit my provision account and debit my profit or loss account or bad debt account, because that is an expense, an increase an expense. Now the other way around is gain. So whenever there is a deduction, if at the beginning of the year my provision for allowance for bad debt is actually 200, then at the end of the year it's now 150. So beginning of the year is 200, end of the year is 150. So the different part of it is what is 50 naira. So what I need to do is I will now debit my provision for account and now credit my profit or loss account, because that is a gain. That will not be a gain. Okay, that will be a gain. Also, you can also credit under bad debts. It depends on the way you want to do it. So showing like a line item on the bill or relating it to your bad debt, none of it will not be penalized for no. Please note this difference. It's very, very important, please. Very, very important. First year of provision for allowance is recorded directly to your profit or loss account. But for the subsequent year, is the difference between the opening balance and the closing balance that you are going to record in your profit or loss account. Now, after that being said, there's what we call provision for discount allowed as well. Now, the provision of discount allowed is at the end of the year, at the end of the month, if you allow people to enjoy discount, you can also make provision for it that, based on this certain customer will take advantage of this discount. So it means that let's make provision for it, so that when the person takes advantage of it, it will be good to go. So, and the provision for the discount allowed is always calculated when you have removed allowance for bad doubtful debt from your trade receivable balance before you now compute the percentage of your allowance for discount on the figure given to you. That is where you're going to compute it. And please, allowance for discount allowed and allowance for bad and doubtful debt will be shown under your statement of financial position. It will be shown. So it's not a net off. It's not expected to be found under a trade receivable ledger. No, it should not be found under a trade receivable ledger, but it will be shown on the face of financial position. And that figure will be used to reduce your trade receivable balance. So that is actually what talk about the bad debt. That's actually what bad debt is all about. So I believe it's clear. Please, if you have any question before we move to computation, you can ask your question. Please use the chat button to ask a question if there's any. Okay. In absence of question, we can move to computation then. We can move to computation. Now let's look at computation. So we have year one, question one. It says that the following information has been extracted. The following information has been extracted from the books of Adams Limited on first. Sorry about that. So it's saying that question one, the following information has been extracted from the books of Adams Limited on 1st April 2018. The provision for discount allowed was 5,830, and the provision for bad debt was 2,234. Discount allowed during the year to 31st March 2019 was 18,824, and bad debts written off was 4,832. On 31st March 2019, debtors amounted to 425,052. The provision from bad debt is to be placed based upon the specific provision of 5,052 and a general provision on the remainder at 1%. The provision for discount allowed is to be 2%. For you to understand this, you can go ahead and read the question again so that you can digest it. Okay. Now, what you are looking for, if they ask you to prepare something like this, you are looking for number one. You are looking for the total receivables. You have to identify that first. So you open trade receivables account. Number one. Number two, you open bad debt account. Number three, you open provision for bad debt account. Okay. Then you now start posting them into it. So let's look at first one. The first one says that the following information have been extracted from the books of Adams Limited on 1st April 2018. The provision for discount allowed was 5,830. So that at the beginning of the year, the provision for discount allowed is 5,830. So you open that as well. You open that. So you open the account, discount allowed, provision for discount allowed, open it, and that will be on the credit balance. That will be a credit balance of 5,830. Okay. And also they say provision for bad debt was 2,234. So you're under your provision for bad debt account as well, you credit the amount there 2,234. Then after that, you say this discount allowed during the year to 31st March 2019 was 18,824. That is what discount allowed during the year. So now if that was the discount allowed during the year, so you open discount allow accounts and post that figure there. So open discount allow, post it there. So what is the impact of this discount allow? It means that it will reduce your trade receivables. It's going to reduce your trade receivables. So you go ahead and post the second leg under your trade receivables. So also they say bad debt was written off for what? 4,832. So bad debt, so open an account, debit it, an expense account. So you debit the amount to your bad debt account. Then the second leg will be found under the what? Trade receivables account. Then on the other one also say on 31st March 2019, debtors amount to 425,052. Now this is the balance. So the balance will be on the debit side of trade receivables. So you put the debt on what? On the credit side of the trade receivables. So you put the amount there. Okay. Now, and I told us that the provision for bad debt is to be based upon a specific provision of 5,052 and general provision on the remainder. So now they are giving us the two different types of provision now. They are giving us a provision that is fixed for 5,052, and they are asking also that there will be 1% on the remainder, and that is the allowance for bad debt. That is the allowance for bad debt. So now that we have identified that, the next thing for us now is to move on to the next thing is not for us to compute so that we can know our total closing balance for discounts, allowed allowance for bad debt, allowance for that bad debt. So we need to know the closing balance for allowance for bad debt. So we have 5,052, which is there already. So for us to now calculate 1%, 1% will be the balance carried down from the trade receivables. That 1% will be from the balance carried down from the what? Trade receivables. If you look at it here, when we open it here, can you see it? Under our trade receivables, our closing balance is 401, 396. That is our closing balance. So before we now before we calculate 1% on it, we need to remove the specific allowance from it. So you can get your calculator. So we need to remove all the specific allowance from it. So I have my calculator here as well. Get your calculator. Then after that, have 401, 396. 401, 396. Now, what is this specific balance given to us? So the specific balance provision given to us is 5,052. 5,052. So say plus, actually minus 5,000 is 052. That will give us 396,344. Now that we have that, then multiply it by 1%. Multiply it by 1%, 11.01. That will give us what? That will give us 3,963.44. Now that figure given to you is the additional provision, okay? It's additional provision. So for us to not get the total allowance or total provision for bad debt, will now be the figure plus the specific one given to us, 52. That's 55052. That'll give us 9,000. That'll give us 9,000. Sorry, excuse. That'll give us, okay. Can you see that? That will be the closing balance. That 9,000 is 015. 9,000 is 015. Now, once we have this 9,000 015, we can now go ahead to compute to close our account. So the next thing to close, you need to compute something as well to close your account. You need to calculate something as well to close your account. That is the allowance for discount allowed. Remember, we have calculated allowance for or provision for bad debt. Now the next thing is for us to calculate what our discount allowed. So the discount allowed is the trade receivables minus, if you do trade receivables minus the closing balance of the allowance for bad debt, then you now calculate the percentage on it. That will give us what? That will give us the closing balance for provision for discount allowed. Discount allowed will give a balance for discount allowed, okay? That will give a balance for discount allowed. So after that, so what do we have again? They will now calculate. So let's calculate, let's compute. So let's close up. So for provision for discount allowed, at the beginning of the year, now I'm referring to the table, provision for bad debt account now, provision for bad debt account. So we have opening balance to be 2,234, and we have a closing balance to be 9,015. So it means that it has increased. If it has increased, that's an expense. So the balancing figure there is that it will be written off to the expense account, bad debt account, or profit or loss account. Now the difference there is 6,781. Now if you look at your bad debt, you see the difference under the debit side. Can you see? Under the debit side, it was 6,781. That's it. Why some of them you see straight on the profit or loss account. So it depends on the one you want to use. Now looking at this one, it's being added under the debit side, 6,781. And if you look at the credit side right now, we are now writing it up to where? To profit or loss account. So we are taking the lump sum to the profit or loss account. Now, if you look at the discount as well, discount, let me show you the discount as well. Or if you look at the discount here, is it here? Okay, yeah, this is it. If you look at the discount that we have here, if you look what the opening balance is 5,830, closing balance is 7,848. That is also increase. That's also what increase in expenses, increase in allowance. So the differential there is the expense element, and that is what we're going to be taking down to the discount. Can you see that? And that's why you take discount allow account, the differential there, that's on the debit side. Add them together, the total figure will now be transferred to profit or loss account, Then this way you show it under your extract. We have an extract here. We have an extract here. The extract is saying that the statement of financial position extract as that 31st March 2019. So if you want to show this figure under our financial position, we have trade receivable will come first. Then we are going to show, we are going to let this way, you're going to let no under our statement of financial position, you normally have 3 naira sign. That's cost, accumulated depreciation, carrying amount. You see the first naira sign, which is cost. That is where we have this figure there. So we are going to have trade receivables, that figure, provision for that debt, that figure, provision for discount allowed, that figure. The non-sum of it, which is 384,553, will now be found under the second naira sign, under the second column. That's the naira sign. There's that on that sign that you are going to list out all your other current assets, It's just for presentation, clarity purpose, and understand for easy understandability, so that people can understand you. Okay, so that is that about that question. So you can go through question 2. Our time fast spent. I will not be chance to go to question 2. So you can go to question 2. If you have any question, you can let me know. So you can go to question 2 and let me know if you have any question. So you have, before we call it a day and meet in next class, you have few you can ask your question. You have 2 minutes to ask your question. Please, you can use the chat button to ask a question. I hope you are preparing well for your exam. Your exam is very close. I believe you are preparing well. Okay, in absence of any question, my host. Okay, I have one. Okay, I have one now. Oh, okay. Thank you. Thank you very much. Thank you, Jalawale. Okay, my host.